in that case. Colleagues, let me start with the global situation. It's not okay out there. Basically, at the World Bank IMF spring meeting, what came out during our discussions is that the global economy is in contraction mode. We expect growth to be of the order of 2.8% in 2023. We expect a bit of an uptick in 2024, but in the next few months to the year end, things are not looking too good. Whether you look at, Africa or other emerging markets, the rest of the world, things are not pointing upwards, certainly in 2023, but there's recovery in 2024. I've got some figures there. You can see, I hope Ambassador Melanie Robinson is not in the room. If she is, forgive me, I have to highlight that the UK will face negative growth this year of minus 0.3%. It is what it is. US at 1.6%, the whole of EU at 0.8%, and so forth. But we see a different story when it comes to India and China. In fact, India is set to grow at about 6%, and China just above 5%. So among the large economies, that's how the split is staked up there. Coming closer home, I've just chosen South Africa and Zambia because they are neighbors. So South Africa set to grow at 0.1% this year, and Zambia with similar growth as Zimbabwe, which is about 4%. But the whole of Southern Africa are looking at growth of 2.5%. So it's softish growth everywhere, colleagues. That's the state of the world. But what the hell is really going on? What's going on is that inflation has been rising for mainly three reasons. One was the initial COVID impact. We shut down economies. That constrained supply. We disrupted global supply chains. And then the tensions emerged, geopolitical tensions emerged as an additional factor. So in response, central banks around the world went into top gear, and they all started raising interest rates. Whether you look at the US, look at the UK, look at Zimbabwe, South Africa, the behavior is the same. That's what central banks do, and that's what they should do, which is to deal with inflation in the only way they know how, which is monetary policy heightening of interest rates. You can see the inflation picture there. I've got some interesting charts, those of you who want to go into detail. I'll just pick out some examples. I'm still scene setting, and then I'll get to capital markets, use of capital market. I'm just looking at the UK here. In January 2022, the policy rate was 0.25%. As of April this year, the policy rate is 4.25%. That's a very sharp increase. Let me pick Sweden for a change. I'll leave the UK alone. Sweden, January 2022, it was 0.25%, and now it's 3%. I'm just using these as examples. US at 0.25% in January 2022, and now at 5%. So clearly, the sharp interest rate increase is being felt everywhere, and this is slowing down economies. I've actually got a chart showing you the increases, trajectory of increases for the US. The Federal Reserve actually has been quite aggressive in this regard. So that's the picture, and that's what is slowing down the global economy. The problem it is creating for us here in emerging markets is that of access to global credit. What's happening? Because banks tend to borrow from the short end and they lend at the long end, the yield curve of interest rates is downward sloping. And that's a problem, because it means that your liabilities, which is your borrowing side, are more expensive than your assets, which is your lending side. That creates problems. That's why then we have banking sector problems. The collapse of Credit Suisse Bank, you heard about that. The bank in California, the same. They were rescued by UBS and so forth, and others. So that challenge, which permeates right across the world, is impacting us here. It means that the credit that we are seeking through private sector channels is now being constrained. Not only is it expensive, it is less available. Those are the facts. That's how we should look inwards and use our domestic capital markets to raise a lot of the credit. But also the implication is that whenever global private sector credit is available, it's likely to be more expensive than development finance. So really, I would like to urge our diplomats present that we want to see more visibility from Proparco, from FMO in Netherlands, and from the UK through the CDC and the successor, and also other development financial institutions, AFDB, European Investment Bank. This is where the credit is cheaper. So please, could you increase your support for Zimbabwe's banks in terms of credit lines? That's the only way we can get cheaper credit globally rather than directly from other commercial banks. Let me turn to the domestic economy a little bit. Colleagues, let me just highlight that we expect a growth this year of at least 3.8%. I'm very pleased with what I'm seeing in the agricultural sector. That's going to give us a good uplift beyond what we had anticipated, and also the continued strong performance from industry. Easily 70% of the goods on our shelves are domestic. That shows that real value addition is happening. It is happening. Thank you very much for excellent performance there. The investment in the mining sector were not even budgeted for inflows from the exports of lithium and other minerals. So that also should push up our expected growth this year beyond 3.9%. The tourism sector continues to perform. You cannot get a room easily over the weekend in any major tourism destination within the country. So that tells you the sector is doing very well, and all of this augurs well for our outlook. So don't be surprised to hear me upgrade our GDP growth formally. I've already signaled this beyond the 3.8% that we focused at. I did say that we have responded to inflation domestically by raising interest rates. I've got two slides there, and the interest rates have been quite high, but of late we've started bringing down the interest rate. But I'm now wondering, with the recent hike in the exchange rate in other markets, should I increase interest rates? Please stop pushing up that parallel market. If you do, I will increase interest rate back to 200% and beyond, because that's what we know, and other measures. So desist from operating in that market and pushing up the power rate, because it is very costly to everybody. Let me now turn to our subject today, which is real industrialization. That I did say that 70% of our goods in the market are now domestically produced. That speaks to successful value addition, but this needs to be accelerated through the right funding sources. So, colleagues, we've got, I would say, 4 buckets of available funding from capital markets, I would say domestically. The first bucket is government-assisted funding through mainly the fiscus in terms of various guarantees and the SDR resources. I'll come back to these in more detail. The second bucket is really on global financial markets, which I've already alluded to. But then, I did highlight that the interest rates are a bit of a challenge, and also the credit rating for Zimbabwe is an issue. But I must hasten to say, recently we overcame that when we actually raised resources, but as government, it could have been the private sector doing it, by involving a credit guarantee organization in South Africa. I must thank the South African government for this. We involved the ECIC in South Africa, which provided a guarantee to banks in South Africa to lend to the Zimbabwe government. They could have lent to, First Capital Bank or to any other bank or industries. That could still have worked, but it just shows you that we can be innovative enough to get around the credit risk element or rating element for Zimbabwe. The third bucket is on domestic capital markets as a source of capital. Here we're looking at the local currency bourse, the Zimbabwe Stock Exchange, VFX, our foreign hard currency bourse, and other exchanges. But there's a fourth bucket, it's missing from that bullet point, that slide, which is on the use of private equity and venture capital finance and direct sourcing of of equity capital from pension funds. All of that is part of the capital market arsenal of possibilities. Now, so looking at the issue of the raising capital from VFX or from ZSC, as a company, we have an option to go public. So, we have got 57 listed companies on ZSC. They've already done that. You can raise further capital through rights issues because it's expensive to borrow out there. So make use of rights issues using all the tricks in terms of the type of instruments. But also, you could make use of the issuance of preference shares. These obviously carry an interest, and I'm sure those who are investing will say, what's your interest rate vis-a-vis the alternative in the money market? And if you're borrowing in Zimbabwe dollars, that interest rate would have to be high. But depending on the tenure of these pref shares, the market might feel sympathetic and allow you to offer a lower interest rate. But that's something that you can also consider as a corporate. But you also could consider debentures. If you are in the property sector, seriously consider using REITs, the Real Estate Investment Trust. It's a fantastic instrument. And some of you, anyone who's a shareholder here in Tigere, did anyone buy Tigere REITs? Hands up. Ooh. Look into it. Look into it because it's a profitable instrument on the ZSC. But also what it does, it allows you as an investor to come in and out and gives you the liquidity to come in and out of property investments without having to sell the underlying properties. And it is the REITs program that really has launched a whole company which is listed on the ZSC. It is my expectation that there will be more REITs listed in hard currency, in VFX, for further developments in the real estate space. You can use derivative instruments. And I've been brainstorming with some of the market operators to see how they can also use exchange-traded funds to raise capital. ETFs are definitely an instrument for easing the liquidity for pension fund investors and individuals into stocks, being able to buy a basket of stocks in one stroke of a pen as opposed to buying each individual. Therefore, you lower your transaction costs. That's really the benefit. So that's what they're used for. But really, they're not really for capital raising and such. But maybe there's an opportunity, especially if it's an ETF for a single share. It's possible to have an ETF for a single share, because then it's directly linked to a specific company. It can be exploited in that way, or made use of in that way. Let me then go into detail on private equity. Some of you have no desire to be listed on any exchange, but make use of the private equity investors as your source of capital. At the moment, we've got a few, Mangwana Capital, you've got also Takura Ventures, we have the National Venture Fund, and others. But my view is that we have too few private equity players. So those of you who are in the financial sector, please let's talk about how we can give you incentives, more incentives as government, to establish, launch, capitalize more private equity funds, because we want to really deepen our capital markets, and this will be a source of funding for our industrialization. What we offer at the moment is prescribed asset status if you want to launch a private equity fund or a venture fund, which will then cause pension funds to support you because they're trying to meet their prescribed asset status targets. So please go for it. We gave Mangwana that privilege. We also gave the CBZ private equity fund PAS privilege as well. So please feel free. Don't be shy. We've got all these incentives for you. These are freebies. And we can exit, of course, as a private equity investor, or if you are the target company, tell them that they must not stay in your company for more than 5 years. They must exit either by selling to the current shareholders or by listing on the stock exchange. So they can go public or do a private, a third-party deal, because they'll have supported you over 5 years. It's more than enough. Now let me press on. I'm going to skip some of the slides. Now, move on to slide 18, please. I'll rush. Now, I just want to mention one or two other instruments that can assist companies to raise capital for their industrialization. It's basically corporate bonds. I'm very pleased with what what's this platinum company, Caro Resources, Caro, did. They listed a bond. They raised $35 million US. I don't know that they still have it open. It was listed on VFAX, and that's a good thing to have a corporate bonds listed on the capital markets. It deepens capital markets, but it gives us additional sources of capital as we try to industrialize. I would like to urge more companies to do the same, because when you raise capital that way through debt, you retain your shareholding. No one competes with you, but of course you have to pay an interest rate. So the market is quite generous looking at the Caro corporate bond in terms of interest rate. So you'll be okay. But corporate bonds is really the way to go, and that way you can lower the interest rate. If you want to borrow at the short end, then it's a bit more expensive, colleagues. If you're going to be issuing bankers' acceptances and commercial paper and things like that, it's at the short end of the yield curve. It will be more expensive for you. So go longer term and issue a corporate bond. Better still if you list it on the market. Colleagues, I just want to say we're developing the Victoria Falls Offshore Financial Center in full. Recently, I announced that the government had appointed a board to start spearheading this project. But of course, the seed is VFAX itself. So we're now building the rest of the infrastructure to create a full offshore financial center which will compete with any financial sector center in the world. The good thing is that Zimbabwe uses Roman Dutch law, which is, I think, as close to English law as possible, which tends to be the default jurisdictional environment for resolving cases around offshore financial centers. So we are okay legally. It's a matter of structure. So we'll be able to use our current laws to make progress on that one. So that way we have a full offshore financial center. So watch the space over the next 1 year. And we're not doing this for government, it's for you. And so the idea is that this VFAX and the center should be used for attracting foreign direct investment, hard currency foreign direct investment, not just for Zimbabwe, but into the region. Where I want to end, colleagues, is I've got charts here about how VFAX has performed, blah, blah, blah. But where I want to end is to just remind you on the other tax incentives that we have already. Some of you are benefiting from these, and all these go a long way in giving you extra capital or relieving you of cash flow constraints. For example, you know already that we give rebates in the pharmaceutical sector, in the clothing sector, in the textile sector, in the furniture sector. So make use of these tax rebates. I know sometimes we take long to process these. We'll try to accelerate, but these are for you to enjoy, and we want you to be supported. We have also in the agricultural sector, we haven't forgotten that sector. We have duty suspensions and rebates for a variety of things, including fencing for farming. You know, if you put a fence around the farm, Dr. Ongwe, you should come and claim your tax from me, and I'm obliged to give it to you. If you drill a ball, Engineer Mara, if you drill a ball, you're allowed to claim for that ball. It's a genuine investment. It's not some, social activity that you do at weekends and so forth. There are a lot of other rebates, colleague, Vice President, as you know, that we have in place, and I'm encouraging the private sector to take full advantage of this cash injection by government in the form of tax incentives into our industrialization agenda. If you're in the mining sector, you can carry, ad infinitum losses into the future, which will then write off against your tax liabilities. So again, that's another donation from government. Make use of it. Better still, if you have a special mining list, there's even more. In the tourism sector, we continue to support that sector in terms of suspension of duty and so forth. But I must say, colleagues, on the duty front, as you know, we're still asking you to pay VAT. It's very difficult for me to suspend VAT. You can, in future, yes, we can suspend it for now, and in future we can sort it out, but I cannot completely remove it. Yeah, I'll get some legal indigestion if I did that. The tour operators, we're supporting you with your vehicles and so forth. When you import vehicles, there's a lot that's going on here, colleagues, in terms of tax support. If you're in a special economic zone, there are even more incentives. Some of you are already enjoying these incentives. Let me just say a few words about our various SDR-funded revolving funds, because this is government's own efforts in trying to support directly industry with resources and not indirectly just through taxes. So, as you know, we established a retooling fund for industry. I don't know whether Minister Nzeza, anyone started drawing down, or they're still trying to figure out how to draw down. We are targeting the cotton sector. It doesn't make sense for us to be producing cotton and then there's no garment manufacturing and then we import all the garment. No. So we are really targeting the garment manufacturing part of that cotton value chain. If there are any garment manufacturers who want support, we'll support them. But I think David Whitehead, whom I had targeted for resuscitation, Minister Nzeza, I think they have enough money, so they're not forthcoming. I said come and borrow this money, but I think they are quiet, so they are okay. So others should come forward and receive these resources. We are focusing also on the leather value chain, the pharmaceutical sector, and then the agro-processing and fertilizer sector is what we want to focus using this revolving fund. So that's additional support from government to support industrialization. Then for the horticulture sector, again, we are supporting this sector through a revolving fund of $30 million US, working with the banks. So again, working with the banks, with the Minister of Tourism, Minister of Agriculture, that's horticulture, to access these resources. I'm particularly keen with support for the coffee sector, because I'm told that those of you drink a lot of espresso, which I don't, tell me that the espresso is not espresso if it doesn't have Zimbabwe coffee in it. So we produce high premium coffee from the Eastern Highlands, and we're keen as government to support that very unique sector through investment in a washing plant, because just by washing those coffee beans and without even roasting or doing anything, you increase the price by 30%. So farmers will be happier, and we feel that they should be supported. Our flower industry will also be supported. On the tourism sector, Minister Ndlovu, we've not forgotten your sector. Again, there are resources, $7.5 million US in a revolving fund that government is extending. I know Vice President is very passionate about gold centers. We did not forget gold centers to support that sector, because 60% of our gold is produced by small-scale miners. So we know our gold center, and in fact, the Pioneer Gold Center is here in Bulawayo, in Bubi, just after Joshua Mkabongoma Airport. That's a Pioneer Gold Center, which is a one-stop center where a miner, a small-scale miner, is assisted with equipment, with crushing facilities, and once they've crushed their ore, they are paid instantly because there's a Fidelity office right there. So it's a one-stop ecosystem. I know I have 1 minute to go. So these are being supported through this facility, and we'll have other gold centers developed in Makaha and in other centers of the country. So colleagues, here we are. These are some of the ways in which capital markets, or indeed government, can support you in your industrialization drive and in our drive to increase and support our value chains. Thank you very much.